Welcome to Tax TV English. We're kicking off episode 1 of our Global Wealth series. Today's explainer, the global billionaire wealth tax debate. It's a huge topic right now, and we're going to give you a clear, totally impartial look at how different parts of the world are tackling extreme wealth. And spoiler alert, they are taking wildly opposite approaches.
So, picture this. You've got shares in a company, and boom, they blow up. You're suddenly worth billions of dollars. But you haven't actually sold a single share. You don't have billions in cash just sitting in your checking account. Your wealth is pretty much entirely on paper. So here's the billion-dollar question. Is it fair for a government to suddenly step in and tax that paper wealth? This isn't just theory anymore, you guys. It's a debate playing out in real time across major global economies. Real quick, before we dive into this whole dilemma, hit that subscribe button for the explainer and our ongoing Global Wealth series. You absolutely do not want to miss our updates on where the world's money is moving, because honestly, these changing tax codes could eventually impact all of us. Okay, here's our roadmap for today. 1. What exactly is a wealth tax? 2. California's billionaire tax proposal. 3. The capital flight debate. 4. India's strategy for capital. And 5. The future of global wealth. Let's get right into it. Section 1. What is a wealth tax? Understanding the core concept. To really get why this is such a hot debate, we've got to make sure we're on the same page about the terminology, right? Because people mix this up all the time. Income tax targets what you actually earn over a set period, like your salary for the year. But a wealth tax, that targets your total net worth. We're talking the total value of everything you own. Houses, shares, businesses, minus your debts. Basically, income is the water flowing into the pool, and wealth is the water already sitting in it. And this leads us to a really crucial concept, being asset rich, but cash poor. Imagine a tech founder. They might be worth, say, $3 billion on paper because they own a massive chunk of their highly successful startup. But that wealth is tied up, it's illiquid. So if the government hands them a massive tax bill, they literally don't have the liquid cash to pay it without being forced to sell off pieces of the very company they just built. Section 2, California's billionaire tax proposal, the November 2026 ballot. Let's look at our first major case study. California voters are actually going to vote on this. It's called Proposition 40. And if it passes, billionaires living in California on January 1st, 2026 will get hit with a proposed one-time tax of up to 5% on their net worth. Now, to be super clear, as of right now, this is a one-time thing, not an annual recurring tax, and the bill itself would be due in 2027. The specifics of this proposal are super interesting. It targets covered assets for individuals worth over $1 billion. But, and this is key, it carefully excludes real estate and retirement accounts. Plus, because lawmakers know all about that whole asset-rich, cash-poor problem we just talked about, they're actually allowing taxpayers to spread these payments out over 5 years, though they'd have to pay a premium to do that. All told, the state thinks this could bring in tens of billions of dollars. So where does all that new money actually go? Well, it's strictly mapped out. Supporters are thrilled because 90% of the collected funds are legally locked in for healthcare services. The remaining 10% goes to education, food assistance, and just covering the cost of administering the tax itself. It's designed to be a massive capital injection right into public welfare. Section 3, the capital flight debate, the pushback against taxing paper wealth. To keep things totally impartial, we have to talk about the fierce reaction from the business world. Take billionaire entrepreneur Mark Cuban, for example. He really hit the nail on the head for critics when he said, "You may be worth billions, but that doesn't mean you have billions in cash." The worry here is that aggressively taxing illiquid shares could totally stifle entrepreneurship, forcing founders to sell out early, lose control of their companies, and entirely change how they invest. It's a massive, high-stakes ideological divide. On one side, supporters firmly believe we need wealth taxes to fund vital things like infrastructure and healthcare, arguing that extreme wealth concentration just has to yield higher public contributions. But on the flip side, critics point out the absolute nightmare of trying to accurately value a private company every single year. Plus, they are terrified of capital flight. The fear is that California's ultra-wealthy will just pack up, move to a different jurisdiction, and take all their future income tax revenue with them. It's such a fascinating standoff. So before we fly across the globe to look at India's playbook, drop a comment down below. Let us know which of these two taxation philosophies do you think actually works best for a healthy economy. Section 4, India's strategy for capital, a fundamentally different approach. Let's contrast California with what's happening over in India right now. India is aggressively positioning itself as a premier global investment hub. And here's a huge historical fact. India does not even have a general wealth tax. They had one introduced way back in 1957, but they completely abolished it in 2016 because it was just too much of a compliance burden. And looking ahead to 2026, they are moving in the exact opposite direction of California. Take their Taxation and Other Laws Amendment Bill of 2026. It is basically a giant red carpet for global capital. They're totally exempting foreign institutional investors from income tax on government securities interest and capital gains. On top of that, they're handing out massive, long-term tax breaks to foreign diamond companies and electronics manufacturers setting up in special zones. And get this, these exemptions run all the way until March 2041. Now, navigating these differing global systems definitely requires smart planning. As former Indian income tax officers always preach, no matter what jurisdiction you live in, ordinary taxpayers should follow 5 core principles. 1. Create your wealth legally. 2. Pay exactly what the law actually requires, no more, no less. 3. Meticulously document your sources of wealth. 4. Realize that legitimate tax planning is entirely different from illegal tax evasion. And 5. Plan your wealth transfers way before crisis hits. Section 5. The future of global wealth, balancing taxation and investment. So what does this tale of 2 totally different systems mean for the future? Well, if any country ever reconsiders a wealth tax, they absolutely have to answer 7 massive questions. Things like, what actually qualifies as wealth? Does this create double taxation? But honestly, the 2 biggest hurdles are always numbers 3 and 7. How on earth do you accurately value private, unlisted businesses? And can the government practically administer and audit those valuations every single year without massive friction? And that brings us to our final, highly provocative thought. In today's hyper-connected, highly mobile global economy, capital can cross borders literally with the click of a button. So how do governments strike that perfect balance? How do they collect a fair share of taxes to fund public services without accidentally driving all their top innovators and investors straight into the arms of countries offering them tax exemptions? That right there is the billion-dollar question we're going to tackle next time. Thank you so much for watching this explainer. Make sure you like, subscribe, and keep a close eye out for episode 2 of our Global Wealth series. We are going to dive deep into the fascinating and often misunderstood realities of international capital flight. You won't want to miss it, so we'll see you then.